Ever sunk your savings into something that promised the moon, only to see it crash and burn?
Yeah.
Think Theranos.
Yo.
Oof, a harsh lesson that even in venture capital, glitz doesn't equal gold.
Right.
You guys wanted the scoop on VC, how it works, the good, the bad, and we snagged an awesome guide.
Oh, yeah.
Pulitzer Prize winner Charles Duhigg.
Wow.
He sat down with us, unpacked this whole world, fascinating and kind of baffling sometimes.
For sure. So billions flowing into startups, hoping to hit that next Google or Amazon.
Yeah.
But like Duhigg says, for every big win, tons of flops.
Right.
Investors left with empty pockets, feeling disillusioned.
So back to basics.
Hmm.
What IS venture capital?
Yeah.
Different from a loan, right?
Totally. Imagine you're this entrepreneur, got a killer idea, an app connects pet owners with walkers, reliable ones.
Yeah,
You need cash to build the app, marketing, hiring, the whole shebang.
makes sense. Bank loan's an option, I guess.
Could be, but interest rates, ouch. And they want steady payments.
Which, new startup maybe can't swing that.
Exactly. So VC steps in.
Instead of the bank, you pitch to these venture capitalists.
Right. Individuals, firms, loaded, willing to gamble on startups that show promise.
Gamble, meaning they don't loan, they invest.
Yep. Capital for equity, they own a chunk of your company now.
Like betting on a horse race, kinda.
Mm-hmm.
Picking winners early, most won't make it, but hoping for that superstar.
Perfect analogy. High risk, high reward. That's VC. And it's all tech all the time, seems like.
True.
Duhigg nails it. That's where the growth is. Tech's always changing, disrupting stuff, new markets popping up.
Plus history's there, right? Silicon Valley, the OG tech hub, VC's been intertwined with it forever.
Absolutely. Hewlett-Packard, way back when, Stanford's influence VC shaped that whole ecosystem.
Oh.
And Duhigg, he's got this funny way of putting why VCs love tech. The Willie Sutton rule.
Oh, I've heard that. The bank robber.
The one and only. Asked him why he robs banks, because that's where the money is.
Classic. So VCs go tech because that's where the money is. Simple, but kind of brilliant. But it's got to be more than just profits. Right?
You'd think.
Duhigg mentions this power shift in VC. What's that about?
Huge point. Used to be, VCs held all the cards, the money, the know-how, they called the shots. But things changed.
How so?
So much money flooding into VC, entrepreneurs got leverage. Not begging anymore.
So they get picky about who they partner with, better terms, all that.
Exactly. Less oversight, more control, even this thing called super voting authority.
Super voting.
Mm.
Sounds intense. What's that even mean?
Basically, some shareholders, founders, early investors, they get more voting power.
Even if they own less of the company.
Yeah. Shifts the control. Total opposite of old school VCs, guys like Tom Perkins.
Duhigg talks about it, right? Good governance, he called it.
Yeah. Perkins, he believed VCs should guide, mentor, not just throw money, ensure long-term success.
Interesting. But that's fading, huh? Entrepreneurs want autonomy.
Seems like it.
Seeing how this power shift could get messy. But before we go there, let's talk VC psychology. Duhigg says, lure of the home run. Meaning what?
It's the core of VC risk reward, the whole deal. The model banks on finding those rare companies, the home runs.
The ones that return 10x, 100x your investment.
Right. Makes up for all the others that tank.
Because most startups don't become Facebook or Tesla, let's be real.
Truth. Most fail or barely make a dent. But those home runs, they cover it all, plus some. Duhigg uses Masayoshi Son's Vision Fund.
The one that bet big on Alibaba early on.
Yeah, they had some flops too, but those early wins, billions in profit. Son's a visionary, supposedly.
But chasing those home runs, that's got to be dangerous now.
It is, like gambler's fallacy. You keep betting bigger, trying to recoup, but the odds...
Not always in your favor.
Right. VCs get fixated on those home runs, miss red flags, throw good money after bad, hoping to salvage it.
I can see that happening. And then there's this blitz scaling pressure.
Oh, yeah. Blitz scaling. Intense stuff.
What's that about?
Dominate fast. Grow like crazy, even at a loss. Grab that market share before anyone else.
Like a land grab, basically.
Perfect way to put it. Duhigg uses Uber investors poured billions in, knowing they had to beat Lyft, be the top dog.
That kind of growth, that's got to take serious cash.
It does, which is where VCs come in.
They fuel the fire. But blitz scaling, there's got to be a downside.
Big time. Winner-take-all situation. A few companies crush everyone else. Competition dies. Maybe innovation, too.
Monopoly game. One player owns everything.
Exactly. And then questions about fairness, the wealth gap, power concentrated in a few tech giants.
So we got tons of money in tech, Power shifting to entrepreneurs, everyone chasing home runs, blitz scaling pressure. Recipe for disaster, right?
Could be.
What happens if a VC realizes their investment's a dud? Can't just walk away.
Nope. Tough choices. They cut funding, basically kill the company. Bad for everyone. Or double down.
Hoping for a turnaround, even if it's throwing good money after bad.
Exactly. Gamble either way. WeWork's a good example. Duhigg talks about it imploded, but big names kept investing.
Shows how that home run dream can cloud judgment.
For sure. And it's not just lone wolves anymore either.
Yeah.
Duhigg talks about VC syndicates.
VC syndicates. Sounds kind of shady, like a secret club.
Not that shady, but powerful, yeah.
Yeah.
Groups of firms pooling their resources, expertise.
So they get the best deals.
Pretty much. Hard for small firms or individuals to compete.
Well,
Duhigg figures maybe 10, 15 funds control most of the VC world.
that's a lot of power in a few hands.
It is. Stifles competition, new players can't get in. Could lead to groupthink, too. Certain ideas get overhyped.
While others get ignored.
Yeah, and then the question is it fair? Are the best ideas getting funded, or just the ones with the right connections?
Right. So we've got the mechanics, the power dynamics, the risk, the syndicates. Big question remains, is VC just about the money? Or is there something more?
Good question.
We hear all this stuff about disrupting, changing the world, making things better. Is that just PR?
Duhigg says a lot of VCs, they really do believe in tech's potential,
Hmm.
but tied to personal wealth too, obviously.
Oh.
He's got this cynical take. Even the greediest person will say they're in it to make the world better.
Bit of spin there.
Probably. VC benefits from that image, right?
Yeah.
Attracts talent, funding, influences policy.
So we got to look past the hype, see what's really going on.
Definitely.
Sounds like we got to dig deeper into this profit versus purpose thing. We got all this money, power shifts, risk, potential for excess. Are we headed for another Theranos?
$1 million question, right? To answer that, we got to look at regulation, accountability, and what we've learned from the messes.
Makes sense.
That's where our deep dive continues. Okay, so big money, hunting for those home runs, needing to grow fast. But what about when it goes wrong?
Right. How do we keep this whole innovation engine from going off the rails? Regulation, accountability, got to be
Right.
part of it, right?
Exactly. Duhigg talks about qualified investors. Basically, gotta be rich to play this game.
Assuming rich means you know what you're doing financially. But is that always true?
Tough one. I mean, if you've got all these assets, you probably learn some financial stuff along the way. Managing money, making investments, understanding risk.
But just because you're good with real estate doesn't mean you get biotech.
Exactly. And that's where incentives can get messed up. Duhigg's point is focusing on qualified investors mostly protects the already wealthy.
Figure they can afford to lose some on risky bets.
Yeah, but it doesn't mean the system's working right or that dumb investments won't happen.
And it doesn't stop fraud, right? Theranos comes to mind.
Totally. Elizabeth Holmes, she got millions from rich folks, not the usual VC crowd, even though. No track record, no proof for her claims.
Shows even qualified investors got to do their homework. Expertise matters.
Big time. And that brings up another wrinkle, VCs on company boards.
Oh, right. When they invest, they often get a board seat.
Yep, voice in decisions, overseeing the company.
But that's got to be a conflict of interest sometimes, no?
Could be. Board members, they're supposed to act for all shareholders, not just their own wallet.
But their interests might not match what's good for the company long term.
Happens all the time. Duhigg uses WeWork, that whole mess. Remember what went down?
Remind me.
WeWork's in trouble, value tanking, and they propose this deal. Good for the board, mostly VCs, but screws over smaller shareholders.
Like employees who had stock options.
Exactly. Board basically choosing themselves over everyone else.
Wow. So how do we stop that? How do we make sure these VC board members actually do their job right?
Man, that's the EE question. Been bugging corporate governance folks forever. Duhigg's got a radical idea and make the consequences tougher.
Like what? Fines?
More like criminal charges if they fail their duty.
Whoa.
His thinking is if they're scared of jail time, they'll be more careful, responsible.
Bold move. But wouldn't that kill innovation? VCs won't take risks if they could end up liable for every decision.
It's a trade-off for sure. Big debate there. Some say it's too extreme. Current rules are enough if we enforce them right.
Others think we need stronger deterrence, especially with all this money, all the potential for abuse in VC.
Yeah, it's tricky. But WeWork shows we need more accountability, somehow.
No doubt. And it's not just stopping outright fraud. It's about changing the whole culture.
Yeah, totally.
Yeah,
VC's thinking long term, building value, not just chasing the quick buck, and thinking about the big picture, how their decisions affect everyone.
right. Makes sense. So we've got due diligence, board conflicts, regulation. But what about the investors themselves? Any warning signs they should watch for?
Definitely. Even pros miss stuff sometimes. Duhig's big on this. Look past the hype.
Easy to get caught up in the excitement. A charismatic founder pitching a revolutionary idea.
Totally. But smart investors, they dig deep.
So what should they be looking for?
The business model, the tech itself, the market, the team, the whole picture. Ask for proof, not just promises, and watch out if someone's being super secretive or dodging tough questions.
Too good to be true. Classic red flag.
For sure. There's always risk in VC, but you can lower it. Do your research, ask hard questions, get different perspectives.
We've covered a lot here. Mechanics of VC, power shifts, the home run obsession, blitz scaling, conflicts of interest, regulation. But what's the takeaway for the average person? Why should WE care about this high finance tech world?
That's the key, right? Duhigg tackles that head on. This isn't some isolated bubble. VC decisions, they affect us all.
It's not just some little bubble, right?
Yeah.
What happens in VC, it shapes the tech we use, the stuff we buy, even the jobs out there.
Yeah, it's huge. VCs, the companies they pick, the trends they set, it all ripples out, impacts our lives, even if we don't see it.
Like, think about it. E-commerce, smartphones everywhere, social media taking over. VC's fingerprints are all over that.
Totally. And it's not just the big tech names either. VCs funding healthcare, education, energy, all kinds of stuff. Duhigg makes this point. It's both good and bad, this influence.
Yeah, I can see that. On one hand, it's pushing progress, solving problems, making our lives better, hopefully.
Right. But then you got Theranos, WeWork. Shows how it can go off the rails, too much greed, not thinking about the consequences. Right? We got to be smart about this. Understand how it works, where the pitfalls are, ask the right questions.
So what questions should we be asking? What can regular people even DO to make sure VC is doing good, not just lining pockets?
Well, for one, we can be smarter shoppers. Support businesses that are doing things right, ethical, sustainable, transparent, all that.
Yeah, like voting with our dollars.
Exactly. And it's bigger than just buying stuff, too. We can talk about this stuff, right? The role of tech, what's ethical, what's risky.
So with friends, family, online even, just getting those conversations going, raising awareness.
Exactly. And we can push for better policies, right?
Yeah.
Support diversity in tech, protect workers and consumers, make sure progress benefits everyone.
So being informed, engaged, actively shaping the future we want.
That's it. And Duhigg, he throws out this really interesting question. It's not about the technical details, it's more like philosophical almost.
Oh, like what?
He asks, if you could invest in a game-changing startup, would you? What would matter to you? What would you need to know before you put your money down?
Good question. Makes you think, right? About how tech fits into our lives, the risk and reward, our own values.
Yeah, not just about the money, but the impact, the ethics, whether this new thing actually makes the world better, like they always say.
It's easy to just get caught up in the hype, the promise of something new. But we got to be smarter than that.
We do. We got to learn from the wins, A&D, the losses, be informed, be cautious.
Well, this has been a fascinating deep dive. Thanks for breaking it all down for us.
It's been a pleasure. Hope everyone listening got something out of it. It's complex, but it's important stuff.
It is. And thanks to everyone listening for joining us on this deep dive into the world of venture capital. Keep those questions coming, and until next time.
Stay curious.